If you felt the market change today and couldn't explain why, you're not alone. One minute everything looks normal, the next minute money is sprinting out of paper promises and into things you can't print. That overnight feeling isn't magic. It's what happens when Washington changes incentives faster than most investors can update their assumptions. The headlines make it sound like politics, but the market treats it like plumbing. A new rule, a new threat, a new priority, and capital starts moving like it's evacuating a building. Welcome back to Wealth Grid Hub. In this video, I'm going to break down what it really means when Washington changes the game, why hard assets can suddenly take control, and how to read the signals so you don't get trapped chasing yesterday's winners. And before we go deeper, quick favor, if you'd like calm, clear breakdowns of money, power, and market mechanics, hit like and subscribe. It helps the channel grow, and it tells YouTube to show you more of this kind of content. Now let's get into the real story, because the market isn't reacting to a headline. It's reacting to a shift in rules, and rule shifts don't just move prices for a day. They can change leadership for years. When people say Washington changed the game, they usually picture a political fight. Markets don't move because of a fight. Markets move because rules decide who gets paid. A game change can look like a tariff signal, a sanctions package, new export controls, a massive spending priority, a tax or subsidy shift, a regulatory pivot, or even a change in tone that signals we're willing to accept certain costs to achieve certain goals. Different packaging, same effect. Expected winners and losers change. And when expected winners and losers change, capital reallocates immediately. That's why you see sudden spikes in sectors that feel close to power, and sudden weakness in areas that depend on smooth global trade, cheap funding, or perfect assumptions. Here, it's the key point most people miss. Markets don't need the policy to fully happen to price it. They price the direction, they price the probability, they price the second-order effects. If Washington signals more friction in trade, that's not just a headline. That's input costs, margins, supply chains, and corporate planning. If Washington signals bigger strategic spending, that's not just stimulus talk. That's demand for real materials, real energy, real production. And if Washington signals that priorities matter more than pure efficiency, then investors start asking a different question. What holds value when the system is actively reshaping itself? Here's the mental model that keeps you from getting emotionally whipsawed. There are imagination-led markets and constraint-led markets. In an imagination-led market, the main fear is missing out. Cheap capital makes future earnings feel almost as valuable as today's earnings. Globalization feels smooth. Inflation feels tame. The winners are often long-duration assets, big growth stories, high valuation tech, anything that benefits from low rates and stable assumptions. In a constraint-led market, the main fear is getting trapped. Energy security matters, supply chains matter, geopolitics matters. Debt servicing matters. Inflation stops being a footnote and becomes a steering wheel. In that world, the market pays for resilience. It pays for scarcity. It pays for assets tied to real-world bottlenecks. And this is why Washington matters so much. Because when debt is heavy, policy becomes more aggressive by necessity. Higher rates make debt servicing harder. Bigger deficits limit easy choices. And at some point, the system has to decide what it will protect and what it will sacrifice. That decision shows up as policy signals, and those signals change what investors consider safe. Hard assets start to win attention in constraint-led markets because they sit outside the easy promises. They don't require perfect growth. They don't require smooth trade. They don't require the currency to stay strong in purchasing power forever. They're not dependent on a story. They're dependent on scarcity. When the market senses a shift from imagination to constraints, hard assets don't just go up. They become central to the narrative. Now, watch what happens on the screen when the regime starts shifting. One or two sectors explode higher. Defense can spike on security messaging. Energy can spike on supply risk or strategic independence. Industrials and infrastructure can spike when the tone is reshoring and rebuilding. Materials can spike when government language starts circling critical minerals, stockpiles, or domestic manufacturing. This isn't random. It's money moving closer to policy power. Because policy power can create durable demand. If the government is going to spend, subsidize, or protect, investors rush toward the parts of the economy most likely to benefit from that. At the same time, broad tech can slip, and people will explain it with simple phrases like valuations or profit-taking. But the deeper reason is this. Tech leadership is extremely sensitive to smoothness and the price of time. If the world gets more fragmented, more tariffs, more controls, more geopolitical friction, smoothness gets priced lower. And if inflation risk rises or rates stay higher, the price of time goes up, meaning the market discounts future cash flows harder. That hits long-duration growth first, not because innovation is dead, but because the math changes. When money is cheap, time is cheap. When money is expensive, time is expensive. And when the market believes Washington is reshaping trade, industry, and spending, it starts asking whether the old growth assumptions still deserve premium pricing. That S, why you can get sector spikes and tech slips in the same breath. It's not chaos, it's a re-ranking. This is where hard assets become a scoreboard. Gold often reflects trust in currency and the long-term value of money. Oil often reflects real economy friction and the cost of doing business. Copper often reflects rebuilding, electrification, and infrastructure demand. Silver sits in a special place because it's both a monetary metal and an industrial input. That dual role makes silver a loud signal in transitions. In the first wave of a shift, silver can look messy. Sometimes it gets hit with everything else because traders sell what they can to raise cash. Sometimes it drops even while hard assets are the headline because positioning and leverage unwind first and logic comes later. That confuses people, and confusion is exactly why silver is useful as a signal. When the system is stable, silver often trades quietly. When the system is being repriced, silver becomes volatile. Sharp drops, sharp rebounds, mixed narratives. That volatility is the market arguing with itself about what the next regime is. Is this a growth slowdown, or is this a rebuild cycle? Is this tight money, or is this future monetary softness? And here is the important part. The market can be bearish in the short term and bullish in the structural sense at the same time. A short-term liquidation wave can smash prices, while the longer-term setup is quietly strengthening underneath. That's why in regime shifts, you must separate what happened today from what the incentives are becoming. If Washington is pulling the economy towards strategic spending, industrial policy, and supply security, that tends to increase resource intensity. Resource intensity increases demand for real inputs. Real inputs are hard assets. That's the chain reaction. It's not a slogan, it's the physics of the system. So how do you tell whether this is a real regime shift or just a headline spike? You watch follow through. Does the sector that ripped higher hold gains over multiple sessions, or does it fade immediately? Do dips in energy and materials get bought quickly, or do they keep rolling over? Does broad tech reclaim leadership with strong, confident rallies, or do rallies feel weak and short-lived? And what is silver doing after the initial move? Does it calm down and drift lower, or does it stay jumpy while refusing to break important levels? This is also the point where correlations start to break, and that's a huge clue. In stable regimes, relationships feel predictable. In transition regimes, relationships get weird. You can see stocks up while credit quietly tightens. You can see the dollar firm while commodities refuse to die. You can see gold hold steady while silver whipsaws. People call that irrational, but it's actually discovery. The market is discovering a new equilibrium. If you want a simple way to stay grounded, use this checklist in your head every time a game change headline hits. Ask, does this shift incentives for years, or is it just noise? Does it increase friction in trade or supply chains? Does it increase the probability of bigger deficits or strategic spending? Does it increase inflation risk or currency erosion risk over time? And finally, does capital keep moving towards scarcity and policy-linked sectors even after the headline fades? If the answer keeps coming back as yes, you're not watching a one-day story. You're watching a new map forming. Let's talk about where this can go, because the future path is what drives the bigger move. There are a few broad scenarios, and each one has a different fingerprint. In one scenario, Washington's shift is mostly about security and strategic industry, while inflation cools and growth holds up. In that case, you can see a controlled rotation. Policy-linked sectors stay firm, hard assets stay supported, and tech becomes more selective rather than collapsing. The winners inside tech are the ones tied to real-world productivity. Defense tech, infrastructure software, industrial automation, and cost-cutting AI, rather than pure growth at any price. In another scenario, inflation stays sticky and funding costs stay uncomfortable. That's when hard assets get more attention as protection, not just as a trade, because the system starts looking for ways to manage debt burdens, and markets begin to price the possibility that purchasing power slowly leaks. Not a dramatic end-of-world event, just a steady grind where cash buys less over time and real scarcity holds up better. And in a third scenario, growth cracks harder than expected. That can trigger liquidation first, selling pressure, volatility, and sharp drops. In that phase, even good assets can fall. But after liquidation, the market tends to separate paper claims from hard constraints again. That's often when hard assets and real economy sectors can reassert leadership. The sequence matters. Fear first, then stabilization, then recognition. The reason I am laying out scenarios is simple. It keeps you from getting hypnotized by one-day S-candle. A regime shift is a process, not a moment. Washington can change direction quickly, but the economy and supply chains change slowly. That gap, fast policy, slow reality, is where volatility lives. And volatility is where most people either panic out or they learn how to read structure instead of noise. So here's the clean takeaway. When Washington changes the game, the market starts valuing resilience over smoothness. Smoothness was the old religion. Just-in-time supply chains, low inventories, global optimization, and the belief that central banks could smooth every bump. Resilience is the new religion. Secure supply, strategic capacity, domestic production, and the acceptance that inflation and volatility may be the price of stability. In a resilience world, scarcity assets matter more, policy-linked sectors matter more, and long-duration narratives become more sensitive to the price of time. That doesn't mean one asset wins every day. It means leadership changes, and leadership is the story that pays. So don't let the 1 minute ago urgency force you into impulsive decisions. Use it as a signal to watch where capital is relocating and whether it keeps doing it after the headline is gone. That's how you tell a true shift from a fake out. Now I want to hear from you. Do you think this is a temporary shakeup or the start of a longer era where hard assets and strategic industries lead? And which asset do you think tells the truth first? Gold, silver, oil, or copper? Drop your take in the comments because I read them and it shapes what we cover next on Wealth Grid Hub. And if this helped you understand what's happening beneath the headlines, share this video with one person who still thinks markets are only charts and not rules. That one share helps more than you think, and it brings the right people into the conversation.